Hello, good evening from London. And today we are talking about the stamp duty hike and what it means for the housing market and the impact, specifically, of course, with buy-to-let investors. But we'll talk also about how it's going to impact anyone purchasing main residence and those first-time buyers. Of course, what we do know is the one that has made the immediate effect is the one for buy-to-let investors. And there's some other to come, of course, in April, which is still going to make some tweaks. We talked about this in depth last week with regards to the autumn budget. Today, we're talking specifically about the stamp duty and the impact that we've already seen after a week and what we expect to see over the course of the next few weeks and months as we go into April 2025. Who are the winners? Who are the losers? Let's find out together. We're going to pull out a few articles. We're going to review them together. As I always say, I love to interpret data and give that to you guys, but I also love hearing from you, whether you're a landlord, renter, buyer, or seller. So first things first, a little bit of a different setup here today, as you can see in the background. And yet, I just want to make sure that you can hear me, you can see me fine, because the mic that we have today is slightly different. So if you give me a thumbs up, who's online? Hey, Edmund, good to see you or have you online. If you can let me, you can hear me. Amazing. Thank you so much. So listen, I wanted to start off with the current market and what we were seeing leading up to the budget. So what we were seeing was a recovery. We were seeing great signs of recovery. Mortgage approvals were up. Transaction levels were increasing, certainly in comparison to 2023, which was an awful end to the year, at least from a property market perspective. And we were seeing that recovery. There was optimism, certainly cautious, but there was a lot of optimism. And those landlords or buy-to-let investors, despite regulations, despite the Renters' Rights Bill, despite the mortgages, the high mortgages that we've seen in recent years and months, were actually quite optimistic. In fact, we've gone through a few articles looking at different landlords with different portfolios as to why they're deciding to actually increase their portfolio despite all these challenges. And then, of course, wham, we've had Labour hit with a few taxes. That being said, I don't believe we've been over-targeted. Landlords at least haven't been over-targeted, and yet there is an impact, at least for those who are looking to expand. So let's dive into a few articles, okay? First one is going to be from Landlords today, and that is looking at stamp duty hike adds £4,000 to landlords' cost nationwide. We're going to break that down as to what that looks like. Okay, so one of the most authoritative sources of residential property nationwide says Rachel Reed's stamp duty hike will cost an average of £4,000 to each landlord purchase costs. The Chancellor announced an increase in the higher rate of stamp duty for additional dwellings, up from 3% to 5%, which took effect last Thursday. Now, I want to put things into perspective, guys. I'm sure you know all about the George Osborne era and when the initial surcharge was added back in 2016. But just in case, I'm just going to jog your memory. So this happened in 2016. Of course, we had that surcharge of 3% on additional properties. And now another 2% has been added to that, which now makes 5%. It was interesting to see Rachel Reeves' wording in terms of this is for people who have second homes, so second homes tax, as if it was just for people who have, that second home as a holiday property. But in fact, it was targeted to buy-to-let investors. Let's be real. And so those landlords who were on the fence, or property investors who were on the fence in expanding their portfolio, are now looking at a bigger ticket in tax hit, of course. Now, I want to break down as to what that looks like, because there's a lot of talk about, landlords, it's the end, and this was the last draw, and we're out. And then other landlords are thinking, well, actually, let's put the numbers together, and does this actually work? And in the grand scheme of things, is this actually such a bad thing? One thing to be said, however, of course, is that leading up to the budget, that momentum in the housing industry was starting to slow down because, of course, it was making a lot of people nervous. They didn't know what was going to happen with the job market, which we'll touch upon ever so slightly. And of course, people want stability. And even if you're not an investor and you're looking to buy your home, you need to be secure. You need to know that you are going to be able to make ends meet at least. So, again, a few weeks and months leading towards the budget, the housing market did start to slow down. So let's go back to that article and see what Landlord Today actually says with regards to the extra cost. So up from 3 to 55%, Nationwide says based on the data for the year to June 2024, this would affect around 194,000 transactions. That's around 1 in 5 residential transactions in England. Okay, so we estimate for a typical buy-to-let purchase, this would add approximately £4,000 of stamp duty. Consequently, this may dampen demand in this part of the housing market, explains chief economist Robert Gardner. In the broader housing market nationwide, says that house prices rose just 0.1% month on month in October, making the annual growth rate slow to 2.4% from 3.2% in September. Gardner continues. The price of typical UK home increased by 2.4% year on year, though this is represented a modest slowdown from 3.2% recorded in the previous month. House prices rose 0.1%. So house market activity has remained relatively resilient in recent months. The number of mortgage approvals approaching the levels seen pre-pandemic. So solid labour market condition with low levels of unemployment and strong income gains, even after taking into account inflation, have helped underpin a steady rise. Providing the economy continues to recover steadily, as we expect, housing market activity is likely to continue to strengthen gradually. So I guess that's the big question, guys. Is the economy going to continue to recover, given that this is the biggest tax hike that we've seen that any chancellor in history has announced and has introduced? That is what we're reading right now. That £40 billion in tax that they want to increase. What we do know is the bulk of it actually is not coming from property, which is good news for landlords and buy-to-let investors out there. However, it is coming from that national insurance tax hike, which is going to impact businesses specifically. And employment is potentially going to take a hit. Employment levels have been low, which is great. Unemployment level have been low, which is great. But that is maybe not going to be the case moving forward. Some of the buildings where we work in, what we find is we have big recruiters, and those big recruiters leading into the budget have been saying that those big companies that do employ a lot of people, and this is from a tech company, finance, and different industries, have been very cautious. In fact, what we're seeing is that temps, and of course, if you're not familiar with that term, it is not people employed full time, but long-term contract permanently, but rather temporarily. And this is something that a trend that these recruiters have been seeing again and again, especially during the months leading to the budget and now even after. And of course, their outgoings, their expenditure has increased substantially or will increase substantially with this national insurance hike. And of course, how does this impact the housing market? Employment is a key indicator, and stable employment is a key indicator. And of course, being able to meet those lenders' criteria and those mortgage approvals. So we're set to see that, especially sort of in the typical residential market. Now, again, this is 40 billion, which most of it is coming from that national insurance. So, with regards to the stamp duty, and let's see if we have any questions here. Danny, will the surcharge of 3 to 5% affect my ability to expand my property portfolio? That depends totally on, number one, of course, your what you have in terms of cash, but number two, what part of the market you're at, Leslie. Certainly, if you're in a region sort of like London, and depending how much cash flow you have, then it is going to have a huge impact. And we're going to look at those numbers together, Leslie. And I hope that these figures that we're going to share with you actually helps in some way. In fact, you know what? Let's jump into this now. But I found an article here which I found very interesting. Okay, so we have some numbers here. Hopefully you can see this. This is one of many examples that I've seen, but I found this one quite interesting. So here you are. So you've got before, in the middle, and after. So if we look at, as an example, £125,000 purchase price, right? Hopefully you guys can see this. So you got £125,000 up to 250 purchase price. So before the 30th of October, that would cost a buy-to-let investor 3% within this price bracket. This is before. Obviously, that date is gone. Nothing you can do unless you have a time machine, right? Now, right now, between now and the end of March 2025, that's going up to 5% if you're within this price bracket. Now, after April the 25th, that's going to go up to 7%. So again, if you look at this, this is double on what you would have been paying just before October 2024. That's a big jump, especially if you're in that price bracket. Now, anything above that, pretty much you've got here 8%, 10%, 10%. So there are really no changes from what I can see in these other price brackets. It's between the 125 to the 250 where really that impact's going to be felt. And of course, at the back of that, naturally, I believe that this is the price bracket where we're going to see more activity between now and April. It is going to be an artificial, of course, demand or push activity created by the government unintentionally. I'm not saying they've done this on purpose, but this is it's a consequence of the policy they've put through. So keep an eye on this price bracket, guys. And of course, if you're here in the capital in London, this is something that's not going to concern you, because you wouldn't be able to buy a garage for £100,000. But certainly there's going to be places up north where this is definitely going to have an impact, or perhaps, and we're going to find out together reviewing these articles, or perhaps buy-to-let investors, from a buy-to-let investor point of view at least, perhaps this is something that is going to be far too much for them to muster, and there is no rush. There is no artificial market being created, because they've had enough and there isn't going to be much here. And what we do know, of course, there are some landlords exiting, but it's always good to break down as to what type of landlords they are. Okay, so before I jump into this next one, which I find this very interesting, actually, let's look at it now. We're here, might as well. I find this particular breakdown quite interesting. So this is looking at, again, before, now, and after, from an investor point of view, from a main residence and a first-time buyer. So if we look at property specifically of £500,000, which now we're talking about London prices. If we look at this specifically before October the 30th, you were looking to pay £27,000 if you were an investor. Right now, you would be paying £37,000, £500. So that is £10,000 more. Between now and April, after April, you will be paying £40,000. So to put things into perspective, if you are a buy-to-let investor and you're looking to buy a property of £500,000, would you really be in a rush to save yourself sort of £2,700 and be out there and compete against other people because you really want to save £2,000 on a £500,000 purchase? Not really. So I don't think that will be much difference in terms of demand. And for those buy-to-let investors that are out there, I don't think there's going to be sort of a huge competition, so people can actually avoid that extra cost. Let's drill down into a main residence and a first-time buyer perspective. So you've got main residents, 12,500 now, 12,500 before, 12,500 now, and then 15,000 when it comes to after April. Again, 2.5 grand. Is it a huge deal? Would you rush a purchase, especially if it's perhaps one of the biggest purchases that you're going to do to save 2.5 grand? Maybe not. But then you've got this one with first time buyers. And this is amazing with me, guys, because it's my understanding, it is my understanding that with Labour and their policies and what they stand for, they are looking out for the working person, right? They are looking out for first time buyers in comparison to buy to let investors and to give them half a chance to get their leg on the property ladder. And I like that. Don't get me wrong. I think that's necessary. Um, and there is no way that I would not want anything that can incentivize and can help first time buyers to purchase their home. However, this isn't this doesn't look like a way that this is actually helping them get on the property ladder. If anything, it seems that they're worse off. So look at this: 500,000, 3,700, 500 before, £3,700, 3,700 now, and then after April, they're paying 10 grand. 10 grand. That's more than double than what they would be paying if they just left things alone. So I can't see how they're helping first time buyers. On the contrary, they've made it worse for them. And there is also an argument to be made, by the way, guys, when it comes to renters. Now, stick with me um, with this theory because it is a theory. At the end of the day, we can only speculate and assume what's happening as we sort of see that trend going on and on certain patterns. That if there are, because this has also impacted the mortgage rates as well, by the way, and it'll be interesting to see what the Bank of England is going to do, which is going to be in the next 24 hours. We'll know what the Bank of England plans to do as well. But hear me out on this. If mortgage rates do start to sort of stay stable or increase again, which that is what we are expecting of quite a few speculation out there. If first time buyers are having are struggling to get onto the property ladder, not only because of mortgage rates, but also because of this hike in the stamp duty. So if they're not buying, what are they doing? They're renting. So there's going to be more demand now. Where it was easing and first-time buyers were able to get onto the property market, finally, now this is kind of pulled back. So more demand. And if buy-to-let investors, a proportion of them at least, are deciding, actually, you know what, more regulations, mortgage rates are high, the Section 24 implementation has really hurt me. We have Section 21 being removed. That scares me. And now, on top of this, I'm going to buy a property and it's going to cost me more money. No, thank you, but no, thank you. That means less supply, more demand, less supply. What happens to rental prices? Rental prices increase. Again, this is my theory. Tell me if I'm wrong. But that's something that we've been looking at in terms of experts, mortgage experts, taxes, and everything else. And that is the kind of the path that I'm seeing. I hope not, but we'll see what happens, especially for renters, because I've said it before and I say it again. Those double digits rent increases that we've seen the past 3 years is just not sustainable. Not sustainable for anyone in the market. So I've been talking a while, and I know we have a few questions here. So let's see. Stephen James, how might this hike impact rental rates, and could it be an opportunity to raise rents? So, James, how might this hike impact rental? So that is a good question, and it's sort of what I've just shared with you. It is that if indeed that demand for properties, rental properties, increase at the back of first-time buyers not being able to get into the property ladder, and the buy-to-let investors decide not to continue to expand their portfolio, then it will have an impact upwards. And unfortunately, for renters, of course, it's just kind of a slap in the face. For landlords, it's good news. I mean, higher yields, but again, from a long-term perspective, I don't believe that double digits rent increases is sustainable. I hope you still hear me because I can hear my AirPods sort of going a little bit funny. Battery is running out. So hopefully you can still hear me and that would be great. So we got Andrew. Hey, Danny, what strategies could help me maintain cash flow despite the higher stamp duty costs? Well, that's a great question. I think that you got to build, and everyone, most landlords are saying this. At least those landlords and property investors who are looking to expand, they are saying we'll just build this into our numbers and make it work. Of course, back in 2016, did it have a huge impact on people buying properties? I wouldn't necessarily say huge impact when the stamp duty surcharge was implemented in 2016, but there was an impact for sure. And I'm pretty sure there is going to be an impact this time round. What, at what level, and of course, what type of landlord? What we do know is small time, accidental, um, sort of casual buy to let investor probably will sort of look away and think, you know what, I can have a better investment elsewhere away from property. And it really depends on what you're looking to build as well. I mean, I had a conversation today with a stockbroker, and he has buy to let properties, he invests in the stock market, and he has a split of both. But one thing that is true is you've got to look at your numbers and see if your money is better placed in equity. That's for something. I'm not a financial advisor. I'm not here to give financial advice, but that perhaps will be best for you to look at with a tax expert. So yeah, I hope that helps in terms of cash flow. I think that's very personal and individual, but I hope that helps in some way, Andrew. And I guess if you are looking to expand your portfolio, then look at where you are in terms of the price bracket and whether you are wanting to make a rush buy. So the only people that governments are looking after is the elite overloads Agenda 2030. Interesting. So the only people that governments are looking after is the elite overloads Agenda 2030. Interesting statement, and I would know a few Labour supporters who probably would want to dispute that, Franco. How true it is that Labour is looking after the elite. Interesting question. Something to ponder. Okay, so looking ahead at another article, let's look at what Foxtons is saying with regards to stamp duty and buy-to-let investors. And it says here, the title is Foxtons boss says stamp duty hike won't deter investors. Let's see what they say and why. So, the chief executive letting sales agency giant Foxton says this week's surprise stamp duty rise for buy-to-let properties won't deter investors. The duty was increased from 3 to 5%, so-called additional homes. Again, so-called additional homes. Just hours after Chancellor Rachel Reeves delivered their budget. Foxton's Guy Gittins says the additional stamp duty charge on the purchase of second homes will add to the upfront cost of investing for those looking to grow their portfolios. However, the scale of the increase is unlikely to deter landlords considering long-term gains of this asset class. We can expect the heightened level of the market activity seen this year to continue, with market momentum strengthening as we head into 2025, further elevated by forecast interest rate reductions. He was also optimistic that Reeves' decision to not apply capital gains tax increases to the sale of the residential property portfolios may keep existing landlords in business. So certainly there was a lot of relief with regards to this. And I mean, if you want to find out more with regards to this one, feel free to go to my previous video. So we've already seen buy-to-let investors return to the lettings market, and today's budget should reassure more and more to remain within the sector. This is good news for tenants across the capital, in particular, as it will deliver desperately needed additional stock back to the market. So again, that certainly would be good news if that is the case. But if it goes the other way, where again buy-to-let investors say thank you but no thank you, and we certainly can see from the numbers that we saw here, and if you just join in, we did look at these numbers whereby first-time buyers will certainly be impacted here by paying double, dare I say, almost triple of what they would have paid before the 3rd of October. That's certainly going to have an impact on them. I mean, they need to find an extra £6,000, £7,000 to purchase a property of £500,000. Here, an investor will pay £25,000 more stamp duty than an owner occupier on the purchase of a property of £500,000. I'll repeat that for your perspective. An investor will pay £25,000 more stamp duty than an owner occupier on a purchase of property of £500,000, increasing from £27,500 before the budget to £40,000 next April. First-time buyers will also pay considerably more in stamp duty from next April than they do now on a £500,000 property, whereas the increase for an owner occupier who's not first-time buyer will just be £2,500. So I don't see this type of profile buyer being in a rush to buy a property. Those first-time buyers are probably going to be the ones that are going to definitely be looking to save, 6,000 plus pounds for sure. Okay, guys, I can see here there are a few more questions. So you got Jonathan. I am concerned what strategy could help me maintain cash flow despite the higher stamp duty costs. This is very similar to the Andrew's question. And again, it depends on your numbers because this is impacting your upfront costs, Jonathan. So not throughout. There's been no changes in the budget to the relief of a lot of landlords that's going to impact your ongoing business. As long as you're not expanding. However, should you look to expand, this is going to be a huge problem for you depending on what price bracket you're in. As I've just showed you, the impact and the increase on £500,000 is substantial. So you got Sonia. Should I reconsider plans to buy additional properties, or could this surcharge benefit long-term portfolio growth? That's a great question, Sonia. And again, it depends on your strategy. Certainly, if you're looking at a buy-to-let and you're looking on holding property, then you should be looking to hold property sort of from a 10 to 20-year period, because that's where you're really going to win in property and that capital growth. Then in the grand scheme of things, depending again on what price bracket you're in, but let's say you are looking at that £500,000 price bracket, and how much did we say? Let's have a look here. Let's go on proper numbers. So you're now looking at an investor will pay £25,000 more. So if you're looking at a £500,000 property and you were an investor, you're now paying, what's that, 13,000, 12.5 grand more come April on a £500,000 property. You're now paying 12.5 or 10 grand more now. Assuming you have the money to make the numbers work now from that upfront cost and you're looking to hold that property, will £10,000 make a major difference 20 years down the line? I don't think so, especially if we look at historical numbers in terms of capital growth, and especially at that price bracket, I don't believe it will make a major difference, Sonia. But that's, of course, for you to make a decision. And my recommendation is you do speak with a tax expert. Again, guys, something to point out here is that anything like a tax expert, a mortgage broker, legal expert, even an agent across anywhere in the UK, one thing that we've managed to do is to build up a solid network of professionals that I can vouch for. And if you need anyone or you need any recommendations, you want me to guide you in the right direction, just go to the description. There should be a link on the description whereby you're able to be sort of provided with information for a great professional. And I hope that's helpful. Okay, so hey Danny, how are you? How does the 2% surcharge increase impact the return on investment for buy-to-let properties? Well, it will have an impact on your yield of return on investment. Of course, it will. And again, that's something that you're going to have to factor in your numbers. Will it have an impact on rental immediately? Potentially. Depending on the number of people who are buying properties, this is going to be factored in their numbers. So yeah, I would believe so. Especially, I would say these areas whereby you're getting just pure new builds and new builds and new builds. I would suspect that all of the buy-to-let investors in that type of neighborhood, of course, they're all going to be in the same boat. They're all having to pay the same type of stamp duty here on. And those are the only rental properties that are going to be available because, again, that's the only kind of units that are within that neighborhood. I would suspect that those rentals will sort of put a new benchmark at the back of this stamp duty. But of course, if we look at other neighborhoods where there are already rental properties, where they are not going, all the units are not going to be impacted by the stamp duty, and only just a few, then maybe not. But again, let's not forget that rental prices are impacted by different factors, and that includes inflation, wages, supply, demand, a number of things. So keep an eye on this, and I would just say subscribe to the channel if you're not, Martin, and we'll be able to give you more information with regards to this. Okay, so what else do we have here? Don't think we have more questions, so we're going to jump into the next article, and I think one would be the actual from Rightmove. And let me have a look here. I guess this will help in somewhat of your question. This is for Andrew and Jonathan. I think this would be a good article to review. So landlord profitability surges to a 2-year high. Landlord profitability has reached its highest point since the first quarter of 2022, according to research by Paragon. So a survey of more than 700 landlords revealed that nearly 9 in 10, 87%, reported making a profit in the third quarter of 2024. Data suggests a stabilization of the market over the past 18 months. A notable 17% of landlords reported substantial profits. Landlords have managed to remain profitable. The bank's commercial director of mortgages, Russell Anderson, said, "Well, landlords have faced a rising cost over the past 2 years. These funds support our brief that I believe that many have astutely managed their business and remain profitable." And I'm going to suspect that most of these, of course, are going to be professional landlords. And it's likely that a key influence of this is the strong demand for rental homes against the backdrop of improving economy as inflation has fallen. Landlords renting to students. Okay, look at from the student point of view. The proportion of landlord survey experience losses fell to 4% in Q3 2024, down from 6% Q2 2024 and 8% in the period last year. Regional analysis indicates that landlords in the east of England experienced the highest net returns, with 90% reporting profitability. And then we've got, of course, the South and West and East Midlands also achieved above average profitability, 89 to 88% respectively. By tenant type, landlords renting to students were the most likely to be profitable, 91%, followed by families with children, 88%, and couples, 87%. Those are interesting numbers. I'm sure that's going to be very helpful for you, Jonathan and Andrew, who've asked more so regards to cash flow. So profitability is up when it comes to those landlords. So I'm going to catch my breath and look at here. So no change, capital gain for landlords says stamp duty change. What is this? Okay, this is an article, an interesting one. Stamp duty changes could have sizable implications for home buyers. Of course, this is what we discussed with regards to home buyers themselves. The UK government autumn budget introduced by Chancellor Rachel Reeves, we talked about this already. Property Mark highlighted that based on the average UK house price of 293,000, those looking to move house could find the stamp duty bill more than double, from 2,100 to 4,600. The stamp duty threshold for first-time buyers has also been reduced from 425,000 to 300,000, which will give thousands of first-time buyers an additional tax liability, which has a potential to affect affordability across the regions. Again, you impact that affordability. And what happens is that those would-be first-time buyers are going to end up being renters for longer, more demand. First-time buyers in London are hoping to purchase an average price house of £500,000 plus are set to be worst affected, having to find an additional £11,000 when the changes takes effect. Based on average house prices per region, those looking to move house will see a typical increase of around 2,500 in many areas. So you've got for first-time buyers, you've got sort of this breakdown, which is quite interesting. So you got England for 478 different stamp duty from 1st of April, 478, 00. Northern Ireland. Those looking to move house, and then here is the difference: 2,500, 1,200, 2,500, depending on where you are. London, 2,500 stamp duty from the 1st of April. And if we look at London here on the average price, £500,000, current stamp duty 14,000, it will go up to £16,000. New stamp duty thresholds from April next year, up to 125,000. I mean, we discussed this already: 2, 5, 10, and 12%. First-time buyers will be exempt up to an initial threshold of £300,000 if the price of the property they are purchasing is below £500,000. So you've got CEO of Property Mark commented the autumn budget will likely uplift the housing market over the coming months as people potentially look to complete before any increases on stamp duty come into effect next April. By the way, one thing I did want to share with you was anyone in the pipeline, because I speak to quite a few agents, and anyone in the pipeline at the moment buying property. Yeah, there's two ways to look at this, of course. And by the way, again, if you can just let me know that you can hear me, it will be very much appreciated, because I'm not sure when or whether my AirPods are coming to an end. So what is interesting, of course, is whether people want to buy property or put things on hold. Let's just look at it from a buy-to-let perspective. Bear with me one sec. Let's look at it from a buy-to-let perspective. And with regards to a buy-to-let perspective, first of all, do you want to buy property right now? But another one is, are you in the process of buying something? Were you in the process of getting exchanged and getting to a point of completion? And then are you at a point where, hang on, I didn't count having to take out this extra 2%, and I'm not sure if I want to proceed. What we're having is, of course, there is a percentage of buyers sort of pulling out, and there is another percentage of buyers actually negotiating back with sellers and saying to them, well, actually, I didn't consider this extra expense, this extra tax, and therefore I want to negotiate with you with regards to negotiate with you with regards to going half and half, 50-50 with this extra cost. Now, why would the seller even want to do that? Of course, it's tax doesn't even belong to me; it belongs to the actual buyer. But we've seen quite a few of that happening, and others that they don't care, they make the numbers work and proceed. If you are buying to let investors sort of listening in, I would love to know what your current situation is. Are you expanding? Were you in the process of selling? Just share with me, because I'm always very curious as to what your thoughts are always. I can't see any other questions at this point, so we're going to jump into the next article. And this one is very much with regards to what's happening in the market right now. So again, if you're just joining us, I did talk at the very beginning with regards to the sentiment in the housing market overall. What we do know is last year was a crappy year when it comes to transactions or property. Of course, I'm talking about property. So mortgage approvals were down. Transaction levels were really, really at the bottom. And this year, we've seen a recovery of that. We've seen that mortgage levels are up. We have seen that those transactions have increased because, again, and I need to point this out, make a point, what we did have last year is certainly not a price crash. There hasn't been a price crash. And in fact, property has been quite resilient. Despite everything that's been thrown at it, it has been quite resilient across the UK. Yet, what we did have last year was a transaction crash, and that we have seen a recovery over the course of the last few months. We've seen momentum, we've seen optimism, dare I say it, cautious optimism, but certainly even with those landlords, buyers, buy-to-let investors, and sellers, we've seen more property come onto the market as well as those sellers who tried to sell last year are, gaining more confidence that they can perhaps achieve what they wanted to achieve. And yet there is still price sensitivity out there. But this budget has put things, in my opinion, what I've seen somewhat on hold. I think that the months leading to the budget made a lot of people nervous. And dare I say it, right now, also, certainly for those businesses as well, as I said before, that national insurance increase has also made a lot of employers quite nervous and quite cautious as well. And that has an overall impact on the property market. So right now, what we have is what's happening in the housing market right now. This is according to Rightmove, and I'm trying to review what specific date this was. Um, but certainly it was after the budget, so it's no more than a week old. So we've seen strong levels of activity in the typically busy autumn season, and lots more looking to get on with home moves than we saw in the more muted market of 2023. As I shared with you, the number of sales agreed is up by 29% compared to the same time last year. I mean, that's almost a third. That's a big number in terms of transactions difference. While the number of people sending inquiries to estate agents is about homes for sale is up 17%. On top of that, buyers will also find more choice of homes, with the number of homes at sale up by 12%. And again, this is due to that confidence in the market on both ends, buyers and sellers. While there's lots of activity in the housing market, we did see lower than average growth in house prices this month compared to the seasonal average of 1.3%. This shows that the market is still price sensitive and sellers are coming to the market, need to set realistic price to find a buyer. And of course, if you are a landlord out there thinking about selling your property, you got to be realistic with the price. A lot of landlords do reach out to me asking me, hey, Danny, is it sensible for me to put my property on the market whilst I have tenants in situ? One thing I will say is a property is always going to sell better at a better price and quicker. From my experience, if the tenant's not in the property, and yet if you don't want to take that risk, there are different strategies that you can take to be able to sell the property for the right price. And of course, that depends on different regions that you're going to be in. If you do need a recommendation to a great property professional who specializes in properties to sell for buy-to-let investors, make sure you reach out to me because I have a network of solid professionals who will be able to help you out and has helped quite a few of our fellow investors who have decided to either restructure their portfolio or who have decided to just sell up altogether. Again, the link will be on the description, so just feel free to have a look at that. Let's see if we have any other questions before we move on. So, would be great to know what percentage of homeowners typically consider refinance when interest rates drop by 2% or more. Um, who told you? Who told you rates are going to drop 2% or more, Leslie? That would be. I would ask that. I'm curious. I'll be curious, and it would be great to find out where you got that number from. Uh, of course, what we've had, Leslie, is quite a number of years of cheap money. I don't think we're going to get to that point for some years. If I'm not mistaken, there are a few experts out there predicting that towards the end of 2025, we may be at the high sort of 3% levels. And with this budget, whether that's actually going to happen now, I'm not sure whether they're going to adjust those predictions. But I'm curious, anyone online, what's the Bank of England going to say tomorrow? Are they going to continue with their statement, which by they had suggested that they were going to take some aggressive action in terms of adjustments to the rates, or are they now going to be able to make some changes at the back of the budget from Labour? So, is there a projected percentage decrease in property values if inflation rates continue to rise as per the current market situation? Well, inflation isn't rising as far as I know, wise process, so nothing to worry there from an inflation point of view. Inflation is in check, as at least as far as I know. And because of that, the Bank of England tomorrow may very well go on with another cut. And now with the election being over in the US, whether it's going to bring more or less stability, I guess it will bring stability as to we now know what we're going to get, whereas before we didn't. From that sense, but if there are those who think that there is going to be more instability because of a Trump win, I guess that's a completely different kettle of fish. And yeah, we can only see, but we have seen markets reacting, right? With the election, we have seen um, some stock definitely increase. I've been keeping an eye on that together with some other fellow investors, and so if we're going to go from the back of that, there's definitely confidence in the market at the back of a Trump win. Whether that's going to trickle down into the housing market in the US and also trickle down sort of across other parts of the world, potentially. You know, our economy in some way are sort of intertwined. But when it comes to property, it is much more hyper local, and what properties do could be different in different countries, despite what happens in a superpower like the US. So let's have a look here. It's interesting to see how cash buyers compare to those financing their real estate purchases in the current market, isn't it? Yeah, of course it is. I mean, if you're a cash buyer in the current market, I mean, it's great in terms of you being able to have that purchasing power and being able to get that yield back. The thing is that property is one of the great things about property, as you may already know, is leverage. And if you're having to put all of your money into a property or properties, really what you want to do, and some may sort of, disagree with me, but what you want to do is put as less as possible because there is a loss of opportunity there of purchasing or buying or investing in other areas. But it is an interesting dynamic for sure. I agree, Edmund. And those cash buyers, we see the most here in London, I believe. We see a lot of those cash buyers, especially in the prime area, buying properties. And it will be interesting to see how, from a super prime price point, with the changes that Labour has done, how that's going to impact that market. But again, that is a completely different world we're looking at from a super prime point of view. I have friends in that market, and I'm due to catch up with them in the next few days to see how they see this impacting. Obviously, the super prime market with the non-dom and everything else, which will impact it. And one thing that we've seen actually in the past, and I don't know if it's going to continue, is whenever there is a shift in the market, it first happens in the prime London area, and it then follows with other regions of the country. And in the same way, when there's that shift, whether that's sort of uplift or whether that is a bust, it always tends to happen in prime London first, and then the rest of the country follows. Whether that's going to be the same this time round, that's something to keep an eye on for sure. So, Leslie, sorry, I didn't realize it was an article I was reading. Okay, great. That's fine. I mean, lots of articles, we can only sort of interpret what's out there. Inflation is only to make inflation is only to make shareholders more money. Potentially, yeah. Potentially. I mean, inflation, there's a close link between inflation, of course, and property. Inflation is property's um, best friend, right? With inflation, you get capital growth. So I agree with you, monkey business. And I will add to that, inflation is to make money for people who have assets. So for people who have assets, inflation is their best friend. I totally agree with that. And yet we need sustainable inflation because if we have inflation hitting that double digit, I don't think it's good for anyone, at least midterm. I'm not sure whether it's good for anyone. I think it will impact even for those who have those those assets. Okay, great. So just to wrap up the last few minutes, it was just looking at this right move article as to looking at a few numbers. So looking at the autumn budget. But one thing we did say, and again, I've seen this in articles again and again, it is with regards to what was this? It was with regards to apologies, I've lost my article, so I'm just going to stop here and start again. This was one of the biggest or the biggest tax rise that we've seen in the history of the country, and it's 40 billion again, and most of that is going to come from national insurance, which is potentially going to impact the unemployment rate here in the UK. And what I found interesting, actually, now that we're talking about sort of in general the economy, inflation, taxes, and so forth, is Labour was quite clever, actually, together with HMRC. So they didn't raise capital gain tax for people wanting to sell their residential property or buy to let property, should I say. Um, Now, this could have achieved sort of some money for them in the short term, but what they figured out was if they raised that capital gain tax, those buy-to-let investors may have decided not to sell and actually hold back and just take a hit on that on inheritance tax. If they had increased to 40%, as an example, the capital gain, they may have just held and not sell at all. And they're quite clever. And what they figured out was actually they kept it as it is, then more people will probably end up selling because that extra tax isn't there, and they will actually end up making more money. And it was a better strategy for them to focus on actually aligning all other assets, with the exception of property, and aligning them and increasing those from 18%, 10 to 18% on the low end. I believe, if I'm not mistaken, 20 to 24% on the higher end. So, you know, they have a bunch of smart people out there, and at least for short term and making money. But again, how is this going to impact the overall market? I read a comment the other day, actually, and they put this together, which I thought actually it's quite clever in the way they put it together. I mean, you hear me out on this. So they said, Labour, this is Labour. Labour, this is like Labour saying we're not going to impact the working people. And by the way, if you missed it, they don't classify, as Keir Starmer says, that he doesn't, I'm going to try and get this right. He doesn't classify, he doesn't see people who have assets or earn money from assets as working people. And therefore, he's looking after the working man or the working woman, and that's who he's looking after. But someone put this together and said that's almost like saying, I'm not going to take a 5-year old's pocket money away from them. They can keep it, or they can keep their pocket money. I'm not going to touch your pocket money. But then they're going to go and take money from their parents, which effectively is going to impact the amount of pocket money that the 5-year old has. Tell me what you think about that comment I read. I read it and I thought, It's a simple way to put it together. Quite a simple way to put it together. Okay, I know there is one question outstanding, and I will come to it after I review this. So, ongoing cost of living pressures are likely to have contributed to the large amount of coverage and speculation the budget has received in recent weeks. Mortgage rates remain high, with our recent studies showing that average first-time buyer mortgage payments are £350 higher than 5 years ago. So we recently surveyed 34,000 people to find out what they wanted to see from the new government. An overwhelming majority of renters, 60%, say they wanted to see more support for first-time buyers. And again, if you're just joining me, guys, I believe we got the absolute contrary to more support for first-time buyers. And I agree. I think first-time buyers should get all the support. And yet, when we look at these numbers, we see that a first-time buyer buying a property for £500,000 before the 30th of October this year now is going to end up paying £10,000 from April 2025. So tell me if I'm wrong, but this is the complete opposite of what people are asking for. And I'll be curious to find out what first-time buyers think about the budget, because I know quite a few first-time buyers who supported Labour and felt that Labour was going to help them. And it will be, interesting to find out what they are thinking about. So what changes were announced for housing in the autumn? So as I said, we've gone through a housing announcement, including the £5 billion government investment to deliver Labour housing plan. So this definitely was something that was announced. And then with 500 million boosts for affordable home programs, and that's exactly what we need here in the UK. So there is a strong demand and a low supply of affordable homes. That is exactly what we want. And here in London alone, they haven't met the target of the number of houses that are required. And yet, what we do know is that the number of the population here in the capital, and overall the country, but in the capital overall, continues to increase, and the supply is just not there. What they promise, it's just not being delivered. Investment is planned for sites across the country, such as Liverpool, Central Docks, with 2,000 new homes and the transformation of the waterfront. There will also be £25 million put towards the delivery of 3,000 energy-efficient new homes. Capital gain tax on residential property will remain unchanged. The government, what's happened is stamp duty. We already talked about this, and yet March 2025, yeah, we're just going to be repeating the same on this. So, guys, I hope that this is helpful. I know. So here we are. We've got Edmund. It's intriguing to compare the UK 5% surcharge with similar tax globally. It's actually higher than some countries, but lower than others, depending on each region's property tax policies. Yeah, I can't speak to that. I know stamp duty overall, Edmund, is a bad idea. Let's put buy-to-let investors to one side and forget about them. Stamp duty is a tax on people moving. There shouldn't be a stamp duty for people moving. I was going to say I promise you, but I am convinced you remove stamp duty, and again, let's remove the buy-to-let investor for 1 second. You remove stamp duty, and I tell you the activity that there will be in the market will be substantial comparison that we have right now. There will be much more activity. There will be more people moving. Stamp duty does put a pause and a break on a lot of people buying properties, moving. And they are, on the other hand, as well, capital gain tax as well. In fact, I know people, and this isn't the norm, but I do know buy-to-let investors, perhaps not very savvy ones, that own properties that are empty. They don't want to rent it, let it out, and they don't want to sell it. They would love to sell it, but the capital gain tax is so much that they choose not to. But at the same time, they also choose not to let the property. Crazy, I know, crazy. Some people are fortunate to have that ability, which even if I had that ability, I wouldn't do, right? Listen, guys, thank you so much for joining me. But that stamp duty, just a recap of what we just seen today. So what we do know is that there may be a little bit of a rush in terms of activity between the brackets of 125 and 250,000 pounds. There's going to be kind of a double, or I say double. It's going to be a couple of percentage now in comparison to what they use, what they would have paid. Um, so if we look at here, 5%, 7%, I guess the damage is done already. So anyone who didn't buy here between this bracket, they're done for now, 5%. But then they've got another one here, increase of 2% in April. And these are guys, these are people within this bracket. These one within these brackets, that's it. You know, there is no particular rush, right? And then we did see an article that on the high end, there will be a somewhat rush potentially. But again, I believe this is artificial. I think come April 2025, I think there is going to be a real slowdown. If you think I'm wrong, let me know. Always happy to hear your thoughts on these type of things. But I'm only here to interpret the data. Thank you, guys. And just on the last note, with monkey business, it's called steel duty instead of stamp duty. I like that actually, monkey business. I'm going to steal that. I'm going to steal that from you. Um, so thank you, guys. Appreciate it. And it is still monkey business. Thank you and have a good evening. Thanks, guys.